Hello guys, let's discuss the solutions for the exercises I gave you last Friday about income tax for individuals. For the first problem, Mr. A non-resident citizen, received a dividend income of 300,000 pesos in 2018 from XYZ Corporation doing business in the Philippines. The following are the gross income of the corporation in the past 3 years. This is just like the example I gave you in our discussion for income tax. The first thing you want to do here is to note that Mr. A is a non-resident citizen and therefore will be taxed only from his income within the Philippines. Next is you get the totals for Philippines and abroad. It's 36 million for Philippines, 44 million for abroad, totaling 280 million. And the percentages will be 45% and 55%. The first question, if XYZ is a domestic corporation, how much is income subject to final tax? Again, if XYZ is a domestic corporation, there's no need to perform the predominance test and therefore the income subject to final tax will be 300,000 pesos. Second question, if XYZ is a foreign corporation, what is the final income tax due? Since XYZ is a foreign corporation, we perform the predominance test. However, we see that for abroad, it is 55%, so it will be the dividend income will be wholly income without, and the answer is 0. For number 3, suppose in 2017 income within the Philippines is 32 million instead of 12 million, what is the final income tax due? We will have revised rates. So for Philippines, we will have 56% rather than 45%, and for abroad, 44% rather than 55%. So we see here that income within the Philippines is now bigger. Performing the predominance test, the dividend income will be 56% within and 44% without. But as you can see, the question here is what is the final income tax due? The answer remains to be 0 because the 56% income within will be subjected to normal income tax since the dividend income is still from a foreign corporation. So we only perform this test not to determine what is the income subject to final tax, but rather what is income that will be considered within the Philippines. Sandra, a resident citizen, appoints the trust department of DBO Bank to manage her money pursuant to a trust agreement. The trust department invests the money in a 5-year corporate bond. Sandra withdraws the money after 8 years, earning 200,000 in interest. What is the final income tax due? So you note that Sandra invested for 8 years, so this is long term. Is she subject to the rules on exemption? The answer is no, because Sandra or the investment was not in her name, but she appointed the trust department of a bank. So for number 1, the income is not subject to rules on exemption for long-term investment. Therefore, we use the rate of 20% to get the 40,000 final income tax due. Will your answer number 1 above change if Sandra is an NRENET B? In terms of not being subject to the rules on exemption, it will be the same because NRENET Bs are not subject to the exemption. But the rate will be different because the rate for NRENET Bs is 25%. So the answer will now be 50,000. Will your answer in number 1 above change if Sandra withdrew the investment only after 3 years? Suppose the income is still 200,000. The answer is no, because in number 1, Sandra was not subjected to rules on exemption, and the same goes to number 3 because the investment was only made after held on after 3 years. Xavier, a resident citizen, invests in a 20-year long-term investment certificate issued by Bank of Manila in his name. He withdraws a total of 600,000 interest income after 8 years. So this is also long-term, but unlike the previous problem, the investment is registered in Xavier's own name. So how much is the final income tax due? This will be subject to rules on exemption, and therefore the answer is 0 or exempt. If he withdraws only after 4 years into the investment, what is the final income tax due? Suppose the interest income is still 600,000. So for the rules and exemption, we have the rates 0 or exempt, 5% and 12%. So 4 years is subject to 5% rate. Therefore, the answer is 30,000. Basing on the original problem, how much is the final income tax due if Xavier is an NRENet B? So again, NRENet Bs are not subject to rules on exemption. Therefore, the rate will remain at 25%, and the answer is 150,000. B1 and B2 formed a partnership and agreed to share profit and loss in the ratio 60-40. The net income after tax of the partnership for 2018 is 1 million. Following the rules on withholding, how much income is to be received by B1 and B2 respectively? We note that B1 and B2 formed a partnership, so this pertains to a general partnership and not a GPP, and we know that a partnership is considered as a corporation under the tax code. So the after-tax net income will be subjected to final withholding tax on dividend before being distributed to the partners. So the share of each partner, based on their profit and loss sharing ratio, will be 600,000 for B1 and 400,000 for B2. But again, these are treated as dividend income and they are subject to a final withholding tax of 10%. So the income that they will receive is 540,000 and 360,000. 2019 was a lucky year for Mark, a resident citizen who recently visited USA. He won the following prizes. So we have Lotto and raffles. The Philippine Lotto is subject to final income tax. The SM raffle is subject to regular income tax because it does not exceed 10,000. For Ruston's raffle, final income tax. Regular income tax for Robinson's raffle because again it does not exceed the 10,000 threshold. And US Lotto is of course subject to regular income tax because this is not from a domestic source. So one question you might have here is that why is the SM raffle and Robinson's raffle being subjected to the 10,000 threshold? So based from my experience in review and answering different exercises relating to passive income, we only usually do not subject the winnings to the 10,000 threshold when the line item is other winnings. So in this example, there's no line item of other winnings, but rather they are enumerated as they are. So question number 1, how much is Mark's final income tax due? So we just follow our categories here. 220,000, that's 200 plus 20, that's 20%. So the answer is 44,000. How much is subject to regular income tax? That's 10 plus 8 plus 50, so 68,000. If Mark is an NRA at B, how much income is exempt? So for NRA at B, only for income within. However, the Philippine Lotto is exempt because that's one of the inconsistencies of train law. They for NRA at B, they remain to be exempt for PCSO winnings. And US Lotto is exempt because this is from a foreign source or this is income without. So the correct answer is 250,000. Let's proceed to problems on capital gains tax. Angel directly sold to Mocha the following: shares of stock of a domestic corporation sold at 1 million pesos with a cost of 380,000. Shares of stock of a foreign corporation sold at 600,000 and the cost of 400,000. First, we get the net capital gains, which are 620,000 for the domestic shares and 200,000 for the foreign shares. The first question is, if Angel is a resident citizen, not a dealer in securities, what is the capital gains tax due? So only A will be subject to CGT because they pertain to domestic shares, while since B pertain to foreign shares, it is subject to regular income tax. The correct answer is 620,000 times 15% or 93,000. If Angel is a resident citizen, not a dealer in securities, but the domestic shares are sold through the local stock exchange while foreign shares are sold directly to the buyer, what type of business tax is due and how much? A will be subject to STT or stock transaction tax, while B is subject to RIT. Letter A becomes subject to STT because the shares are now sold through the local stock exchange. So the business tax due is STT and the amount is 6,000, which is 1 million times 0.006, which is the rate for STT. If Angel is a resident citizen, a dealer in securities, and the shares were directly sold to Mocha, how much CGT is due and how much business tax is due? For the CGT, since Angel is now a dealer in securities, therefore the stocks or the shares of stock are no longer considered as capital assets because they are now part of the inventory of Angel. So the CGT due is 0. For the business tax, since Angel is now engaged in the business of buying or maybe selling shares of stock, then A and B will both be subject to VAT. However, the special case here is that for shares of stock, the basis of VAT is not the selling price but the profit. So the correct answer is you add the 620 plus 200, then you multiply it by 12% to arrive at an answer of 98,400. Next, Charlene sold to Denise her parcel of land in Batangas held as capital asset with a zonal value of 2.7 million and assessed value of 2.4 million. If the selling price is 3 million, what is the capital gains tax? So we know that the tax base is the higher of fair market value and selling price. So that's 3 million, which is the highest, times 6% is 180,000. If the selling price is 100, what is the CGT? So this is just a number that will make you think, but the same rules will apply because the base will still be the highest of the three, which is 2.7 million times 6% to arrive at an answer of 162,000. Daphne sold to Dante her principal residence with a fair market value of 4.8 million at a selling price of 4 million. Daphne informed the AR of the sale within 30 days and established an escrow account. She also used the proceeds to acquire a new principal residence within 18 months. So 4 million is the proceeds. If the new residence also costs 4 million, how much is the CGT due? So if Daphne uses the whole 4 million to buy the new residence, then Daphne would have complied with all the requisites to be exempt from CGT on sale of principal residence. Therefore, the answer will be 0. But if Daphne used only 3 million of the proceeds, how much is the CGT due? So we just get the proportion. The CGT that's supposed to be due is 4.8 million, the higher of the fair market value and selling price, times 6% equals 288,000. And the portion not used is 1 million out of the 4 million because Daphne only used the 3 million. So we multiply 288 and 1/4. So the CGT due is 72,000. Let's proceed to problems on regular income tax. Mr. Y is a CEO of a corporation and practices his profession by the side. He had the following data in 2018. So we have receipts from profession, expenses on the practice of profession, gross compensation income as a CEO, and interest income from bank deposit. Assuming Mr. Y opted to be taxed at 8%, how much is his total income tax for the year? The first question we ask is that is he allowed to choose the 8% option? The base will be gross sales receipts plus other income, which is only 2.5 million, and this does not exceed the 3 million threshold. We do not include the interest income from bank deposit because this is subject to final income tax. So the types of tax are the 8% tax on the gross receipts from profession, which is 2.5 million times 8% equals 200,000. The regular income tax on compensation using the graduated tax rates because again, the 8% option is not allowed for compensation income. And finally, the final tax on interest income from bank deposit, which is 600,000 times 20% equals 120,000, arriving at a total income tax total income tax of 2,090,000. Ali is a part-time gym trainer and also operates a shoe store. In 2018, the gross receipts from training services is 400,000, while gross sales from the shoe store is 1.1 million. The cost of sales and operating expenses amounted to 150,000 and 35,000 respectively. Ali signified her intention to be taxed at 8%. The question is, what is the income tax due? Again, we first ask if she is allowed to choose the 8% option by getting the base. So that's gross sales or receipts plus other income, which is only 1.5 million and again does not exceed the 3 million threshold. However, what's tricky here is that Ali is a self-employed professional or individual and Ali has no compensation income or any income subject to regular income tax. Therefore, the 1.5 million gross sales or receipts, we have to deduct 250,000 before multiplying it to the 8%. Therefore, the correct answer is 100,000. Angela owns a taxi business and earned the following in 2018. What is the income tax due if Angela opts to be taxed at 8%? Again, we ask if she is allowed to choose the 8% option. Basing only on the tax base, which is gross sales plus other income, Angela does not reach the threshold of 3 million. However, since the business is a taxi business and this is subject to common carriers tax or other OPT, then this makes Angela disqualified or ineligible to choose the 8%. The correct answer will be 295,000 using the graduated tax rates. So that will be gross receipts of 2.5 million plus 800,000 plus 350,000 and the income will be subjected to the graduated tax rate to arrive at an answer of 295,000. In 2019, John, who signified his intention to be taxed at 8%, had the following gross receipts for each quarter. By the end of the year, John had total costs and expenses amounting to 4,440,000. Question number 1. How much is the income tax payable for 2019? First, we note that upon reaching the third quarter, John reaches the 3 million threshold and therefore after that quarter he is no longer eligible to the 8% option. So using the graduated tax rates, we get a tax due of 509,200. So you first add all the gross receipts amounting to 6.5 million and then we less the costs and expenses amounting to 4,440,000. So upon getting the income, use the graduated tax rate and we get a tax due of 509,200. The tax credit is the 8% tax payments from quarter 1 to 3, which is just 3 million times 8%. So the tax payable for 2019 remains to be 269,200. How much is the business tax due for the year? So the first 3 million will be subject to 3% OPT, while the excess will be subject to 12% VAT. So that will be 3 million times 3% plus 3.5 million times 12%. So the answer will be 510,000. For the last problem, we see here different types of compensation income. Whenever you see a problem where it lists down or enumerates different types of income, what you want to do is to mark each item, whether they're subject to regular income tax, final income tax, and capital gains tax. Also put in the rate if it's final income tax so that you won't miss any items and you will get the correct totals for each type of tax. But for this case, these are all these are all compensation income, and what's being tested is your knowledge of the minimis benefits. Few things I'd like to point out for the first item, the 5,000, 6,000, and 2,000 are not taxable, so we just deduct that, and then for other items, these are the minimis benefits. So the excess is not immediately taxable. For example, for rice allowance, the 6,000 is not immediately taxable. Remember that the excess, the minimis benefits over the ceiling will still be pulled together with other bonuses, and then they will be compared to the 90,000 threshold. Okay. So for rice allowance, the limit is 2,000 per month or 24,000 a year. Productivity incentive under CBA is 10,000 a year. For medical allowance to dependents, 250 per month or 3,000 per year. Medical assistance to employee, 10,000 per year. Uniform clothing allowance, 6,000 per year. For monetized sick leave credits, these are not the minimis benefits for private corporations or private employees. Monetized vacation leave credits is only up to 10 days. So the Best Employee Award finally should have been given in as non-cash for it to be considered as a de minimis benefit. Then you see here before the total, this is the 90,000 threshold. So you just deduct that because adding the bonuses and the excess de minimis benefits altogether will exceed 90,000 anyway. So totaling this, you will arrive at an answer of 1,840,000.